Good morning, everyone, and welcome to this special webinar in conjunction with the Capital Club. Today, we're going to be looking at some insights from our various publications. My name is Taiwo Oyedele. I'm the Fiscal Policy Partner and West Africa Task Leader for PwC. I'll be your anchor for this event. So as a way of housekeeping, so this is a small group. It has been deliberately kept to a few people who have been invited to participate. And we're going to be having some insights from some of the authors of our Insights publications. For the purpose of today's session, we have selected 3 of those insights, on which we're going to have some discussions later on today. Please note that this session is being recorded, essentially for us to be able to share the recording with you at the end of the program. If you want to make any contributions, again, because it's a small group, you can easily raise your hand, use the raise hand function. You see it just above the chat box. And then you'll be allowed to speak. You'll be unmuted and you can speak. If you wish to give a feedback, you'd also see the button for giving feedback. For example, you may want to draw attention to the fact that we're speaking too fast, too slow, or maybe you just want to give an applause or you want to laugh. All right, so having said that, I would quickly then pass it on to our first speaker, who is one of the authors of our publication around how COVID-19 is impacting on financial reporting. And that is Bolanle Adekoya, who is the partner and lead for capital market accounting and consulting services at PwC. Over to you, Bolanle.
Here with you and sort of talk you through some of the highlights that we have included in our insights around COVID-19. The truth about it is that COVID-19 took everyone by surprise, and there are a lot of issues and consequences that sort of came as a result of it. And I'm just going to spend the next few minutes sort of talking about some of the financial reporting implications of COVID-19. One of the things with regards to COVID-19 is the fact that even though it's sort of gradually sort of easing up with regards to the health impact, the actual economic impact, which in turn affects the financial reporting impact, will still be with us probably for another year or so. And a lot of decisions around those key financial reporting implications need to be looked at so that you're not caught sort of unawares. And the truth about it is that things like the impact on inflation, the macroeconomic factors, things around the ease of doing business, sort of moving around, things around the exchange rates, commodity prices, a lot of these things are sort of there. And one of the things that we need to also do, the reason why you need to know about the key financial reporting implications is so that you can tell the story in your books, because it's your financial reports that analysts are going to have a look at. It's what people are going to use to make decisions whether they want to invest in your business, or even for yourself, looking at things around your budget, looking at things around some of the forecasts or assumptions that you have made, and even around the valuation of your assets. So there are 3 key areas I want to focus on today: assets and liabilities, income and expenses in your financial reports, and as well as presentation and disclosures. So quickly around assets. So your assets in your book, during the time that you would have had some of the lockdown or restrictions in doing business, there's some of your property, plant, and equipment that you may not necessarily have used. And for your situation, when it comes to things like depreciation and amortization, you would have had to continue. You would have actually had to continue to put this expense effect in your balance sheet and your income statement, even though they may have been idle. In addition to the assets, your fair value of some of your financial instruments, fair value around your other assets that you may have been carrying, whether it's buildings or certain receivables that you may have had, the change in interest rates would have also affected the valuation, because interest rate does have a correlation to some of these things. So it's important that you have reassessed it and make sure that you're not carrying these things inflated, even though you may not necessarily have used them. Things around impairment. So, for example, under IFRS 9, some of the receivables that you would have had, whether it's loan receivables that may have been an asset if you're in a financial services organization, or even some of your debtors. Some of these things would have been affected by time value of money. Maybe people are not paying, or even the fact that your expected credit loss model under IFRS 9, some of the assumptions would have changed because your forward-looking information around as a result of COVID-19. So inflation rates, foreign exchange, commodity prices, oil prices, of course, would have all been affected. So you will need to sort of reassess this and be able to tell the stories and make the appropriate adjustments, which may reduce your profits this period. Even provisions, maybe you may have had redundancies or reorganizations due to COVID. Of course, all these things will also you will need to look at it. Even your inventory. So, under IFRS, you know that inventory is, as a result of, is the net realizable value. So what is your net realizable value? So you may have carried asset inventory for a while. They may have become obsolete. There might be some damage because they're just been sort of sitting there. So you will, of course, need to make the appropriate adjustments. Another thing that may have also happened was the fact that maybe there are some transactions that you have come into, so some business combination, maybe you wanted to do some mergers and acquisitions, but now you will need to look at some of the assumptions that you made around this and whether even any goodwill that you may have resulted of it will now be affected as a result of some of the change in macroeconomic factors. And there is a trigger of impairment. So one thing that COVID is a trigger of impairment. So because of that, you will need to carry out an impairment assessment on both your financial and your non-financial assets. And all of these will have a direct impact on the carrying value of your assets and liabilities in your book, and in turn, your income and expenses, which then brings me on to income and expenses. One of the things is that, I talked about write-down of certain assets, revenue recognition. So maybe the timing of some of your revenue may have changed as a result of changes in contract or certain concessions that you may or may not have made, or even government may have made. So, for example, we know that the government gives certain palliatives to people, and these palliatives actually have an impact. And, if, for example, they gave a grant or they gave additional moratorium, some of this you may need to assess and find out whether this thing should be recorded under IAS 29 for you as an other income, or is a capital contribution to you, or a reduction to your cost of sales. So these are things that you will need to, of course, look at. What about even timing of tax expenses? So there's some individuals that may have been given a period of time. We know that there were extensions that were given by the FIRS. How does that work in your books? You will still need to calculate things like deferred tax assets, even though there might be a break or an extension. You will still need to calculate this because it's an accounting item. With regards to timing of payments, depending on your year end, you will actually have to have a look and see whether there really is an impact or whether you will need to do any discounting. But the discounting will be minimal. Because some of the periods that they're giving a delay to are very low. Other items around employee benefits or even share-based payments. So, for example, if you've done any transactions in the period to try and compensate your staff, maybe you're not paying your staff and you've had to do so a furlough, and you have a situation where maybe you've deferred employee benefits or you're giving other benefits in kind, all this will impact your employee benefits, and you will need to do an assessment and make sure that you're carrying them at the appropriate amount. So I just want to now end on presentation and disclosures in the financials. So a lot has happened. So one of the things that you'll find is that because of the uncertainty of the overall impact of COVID, you will need to add additional information to help the users of financials actually understand what the true impact to you on your industry, to you on your business, including any estimates or judgments that you may have made. The truth about it is that in some cases, some of you may be relying on certain government interventions or regulatory interventions to still be able to run your business, or there might be some uncertainty about the timing of some of the payments that you would have received. All these things will need to be disclosed in your financials. Now, some of you may ask, how much is too much information? Put as much information as you can, because one of the things that the standard setters with regards to IFRS require is that you must give enough information that is free from bias and fair information to allow the decision makers and your stakeholders understand what you're trying to do. So you will need to do it. There's a lot of guidance that we provided in there about some example information, actually even around your interim period. So some of you may do half-year reporting, and your half-year reporting would have been whether June, and you've got another interim coming in September for those of you who want to pay interim dividends. So it's important that you're able to give them the effect, so both the qualitative and the quantitative impact of COVID to you, and the sensitivities around it. So sensitivity around your sales, whether your sales have been affected, sensitivity around some of the government palliatives that you may have been relying on, sensitivity around your asset values, sensitivity around the effect of maybe inflation or exchange rates, or even some of you may even be having treasury bills or certain assets that you may need to start looking at with regards to discounting. So please do that. And then the last information that you need to disclose as well is around going concern. So whether the business will be able to keep running after 12 months, post the reporting period that you are looking at. So I hope that's helpful. I mean, it's a short presentation, but as I said, there's a lot more insight in the document that we provided. I just wanted to just give some snippets about the things that you need to think about. And to just say, remember, know your story, plan how you're going to tell the story, and then tell the story as well. Thank you.
All right, very well. Thank you very much, Bolanle. That was a very quick but comprehensive overview of the implications of COVID-19 and the impacts on financial reporting. We'll certainly be coming back to you with one or two questions later on in the course of today's session. Just to say that the three publications we are discussing today, two of them have been published already. One is in the process of being published, but we have the pleasure of having with us Siria Agbeyi, who is the tax partner and lead for our private client services in tax, who is going to speak to us about issues around offshore trust and what we need to be looking at differently. Over to you, Esiri. Esiri will be supported by Folajimi Akinla, lawyer and the lead for our tax controversy and dispute resolution. Over to you.
Thank you, Taiwo. Good morning, everyone. I'm happy to be here. And very quickly, what I'm going to be talking through is re-examining trust and assets in a crisis. As Bolanle had pointed out, the pandemic did not come without shocks. But I think with every shock, the more resilient persons are the ones who come out quickly and try to reassess what could have been done differently. According to the Amnesty International, USA, there were more than 80 countries in the period of the pandemic that declared states of emergency. And most times where we find such situations, it's usually characterized by political uncertainties, with government suspending laws to carry out acts that could probably benefit the state. And those could include wrongful expropriation of assets or seizure of those assets. Whilst we didn't have such a scenario in Nigeria, I think this slide, if you could just press forward, whilst that didn't come with, what we would have seen in other jurisdictions or what we saw in the Arab Spring, we didn't see anything like that here. But then these are still issues worth considering. And like I said, in re-examining such situations or positions, one of the key questions that came to mind was around trust assets. how do I preserve my trust assets? And just for the benefit of those who might not have deployed a trust, they are usually vehicles used for wealth management to protect assets from perhaps creditor claims, but also have some benefits in the sense of estate planning so that you don't go through the process or administrative process, for instance, that comes with probate, and sometimes also able to use those to avoid estate taxes. Having said that, what could have been the considerations with assets, that I have now held under a trust? Nigeria does not have a very robust legislation when it comes to trust assets. And so what we find more often than not is a lot more Nigerians protect their assets using offshore trusts. And such assets could include, just your luxury yachts or your jets or real estate that are in other jurisdictions apart from Nigeria, landed property and so on. And so some of the questions around this is, to the extent that a country then declares a state of emergency and these assets are at risk of seizure or can even be claimed by creditors, what options do I have in terms of protection? And there are a lot of other options as well that could trigger those, creditors, like we said, government regulation that are changed, like we saw in the Bahamas. We saw that there was even a change in the way certain clauses within trust arrangements are utilized. State of emergencies, we said, and economic downturns as well. Now, the basic consideration really is around how the trust is constructed in the first place. How have you set up that trust? And there are two major considerations to that. The residents of the trust would largely determine how much protection the assets in that trust could have, and that residence could be defined in different ways depending on the country. It might be that it's where the settlor, that's the person who has created the trust, is based, or even where the protector, if I would assume you identified someone other than the settlor who could veto decisions that are made by the trustee, or for instance, where the trust is even administered. All of these different parties who control or influence the trust will determine the residence of the trust. And to the extent you then identify a country that's sitting as the residence place for that trust, it also will determine the extent to which those assets are protected. So again, go back to the initial point. How have we constructed that trust? And what are those factors that we have taken or looked at properly to ensure that we don't expose ourselves to undue locations or unnecessary locations, and then therefore widen perhaps litigation net? That just only heightens, the kind of issues that you have to deal with, and then reduces whatever protection level could have come with the trust that had been created in the first place. The other thing to also look at, of course, is the laws that regulate the trust. Now, having said that, there are a number of options available to protecting trust assets. And again, it goes back to how that trust was constructed in the first place. The first thing is around plea clauses. Plea clauses tend to be clauses that are used in this kind of area. And what it tends to do is give the trustees power to be able to flee in a time where the powers that they have around the ownership of those trusts or the exploitation of those trusts are called into question. So if, for instance, a state comes and says, the trustee who is now legally holding that trust asset has to give up the asset, what can we do to ensure that that trustee is not put under undue pressure to give up the assets to the state or even a creditor? And the plea clauses present themselves as a useful tool to either suspend the powers of the trustee during such a time, or even allow the trustee be able to move those trust assets from the location where those assets are administered, for instance, to another location or another trustee. Now, the beauty of having those kind of clauses would be how easy it is to then move from one trustee to another trustee, or how easy or quickly it is to move from one location to another location. The assets may not necessarily move, but the control is what is moving, so that you're moving to a jurisdiction that offers more protection in times of an emergency like that. And so it has to be really done quickly. So the construct of that asset or that trust arrangement really determines how quickly such things can happen. Other clauses as well that may be put into the trust arrangement to offer this kind of protection to the extent that the trustee, is perhaps hit with a Mariaba junction. So you have a ship and the ship is somewhere mobile, is on the sea, and you have to move that to another jurisdiction for protection. A creditor who is seeking to claim or repossess that may look to even dispossess the trustee of that ship despite the plea clause. And to that extent, there are other clauses as well that tend to offer protection. And those are really reliant on what kind of powers you've also given to other parties within that trust arrangement, whether it be the settlor, so that the settlor has some reserve powers and the trustee is not the only one with absolute powers to control or make decisions, or a protector. And that protector might be someone who, like I said before, vetoes the decisions or overturns decisions that have been made by the trustee. And so that to that extent, he then acts as a blocker against whoever may potentially seize those assets. Over and above all of this, like I said, there are a lot of factors that determine what kind of options you pick. And these kind of actions or solutions that you then take would really be driven by the facts of the case and what you had determined at the time you put the trust in place. And so properly detailing those out before the trust is even created in the first place is very important, because at the time when the crisis happens, it's not when you want to start taking the action. It's something that has been thought through before the trust arrangement was created, so that full protection is, available despite possible uncertainties like what we saw with the pandemic. Or even if it did happen, what options do we have to quickly make amends at the time it does happen? And so I think I would just close here. And to the extent that there are questions, I'll be happy to take those subsequent to the presentation by my colleague.
All right. Thank you very much, Esiri. So that was very useful, particularly in terms of how do you protect your assets in these very uncertain times when things are also moving very quickly. You almost have to keep up to date by the minute just to be sure that nothing goes wrong. We'll come back to you again also for one or two questions after the last section that we're going to go to now. If you have just joined us, this is a very exclusive session for executives to discuss 3 of our top leadership publications around COVID-19. And you can raise your hands using the function you have just right over the chat box, and then we'll recognize you to speak at the appropriate time. Next, we're going to take Benga Adepetu, Associate Director here at PwC, who will be speaking to us about how do you cope with COVID-19 within the context of cost management and value optimization strategy. Benga will be supported by Emo Whitefuna, who is a Senior Manager in our Advisory Services Unit. Over to you, Benga.
Thank you very much, Taiwo. Good morning, everyone. Nice to be with you this morning. Like Taiwo mentioned, I will just be looking at some cost management and value optimization strategies that businesses can adopt in the face of the impact of the COVID-19 pandemic. As has been mentioned by my colleagues earlier, the pandemic has hit us in different areas and different forms as well. And businesses have suffered in one way or the other with respect to either their operations or revenue or even cost, as the case may be. So this morning, very quickly, I will be talking to you with regards to this. Next slide, please. Next slide, please. Thank you. Thank you. The government of Nigeria, and as the same with the government of many countries, have tried to cushion the effects of the pandemic by providing palliatives to businesses in one way or the other. Government has tried to defer taxes in some cases, government loans. They've also tried to extend moratorium periods just to see how they can support businesses in these difficult times. However, we've had organizations contacting us or asking us to say how can they benefit or how can they be part of it. So the reality is that many businesses are yet to feel the effect or even enjoy the benefit of some of these palliatives that government has put in place. And of course, what that means is that their business has been impacted in different areas, from revenue to unemployment, impacting your workforce, impacting your finance and liquidity, and also supply chain, as the case may be. Depending on the area of the business of the economy where you play, the impact may be high or low. As we have from our own assessment, we've observed that the entertainment, luxury, travel agency, and hospitality business have been most hit, while businesses in the food and beverage and health and safety perhaps have they've seen better days. A survey that PwC carried out sometime in April 2020. We interviewed executives, senior executives, and business owners just to see what are their biggest fears in terms of the pandemic, or how are they reacting, or how are they responding to the effect of the pandemic. And 65% of them actually responded that they're actually thinking of canceling investment, new investment, expansion drives. They are not even they're just canceling that idea at the moment. And some of them who have even commenced expansion drives or expansion activities are deferring them until a later date. One other area that has been in line with even the World Bank forecast is recession. Many business owners are actually scared that we may just slide into recession. And the World Bank forecast that globally they're expecting the global economy to contract by about 5.2%. And they've also gone ahead to say that even in Nigeria, we'll probably see the worst recession, the worst recession ever will probably come on us in this period. And 77% of business owners are actually looking for ways they can actually manage their costs. And of course, in the light of that, PwC, we have decided to take a deep dive into this area. But one thing that I would like to say is that cost management is not something that should be done when you are in trouble. But that is what we have observed right now with many business owners and many CEOs. Cost management should actually be looked at holistically. It should not be looked at, and it should also be looked at strategically. Without saying much, the objectives of an organization or your organization should be considered when you are looking at cost management, and not just when there's a problem or when you get into troubled waters. Having said that, why in the first place would we be talking about cost management? The major reason why cost management will come into play is when you are not making sufficient revenue, when you are not getting across to your customers as you would expect. Then, of course, at that point, you don't have enough sales to be able to meet the cost of your business. And so it is quite imperative that you start from the top line, which is your revenue. You may need to, at this point, begin to look at your sales strategy. As you know, the pandemic has led to our customers behaving in a certain way. So many of the customers are also shelving luxurious spending, or they're shelving so many costs at this point in time, and also they're also buying in a certain way. So you may need to look at your your sales strategy to be able to retain your customers. Beyond that, you may need to look at your existing contracts, contracts with your clients, your clientele. You may need to look at them and see whether you can renegotiate the terms of those contracts in the face of the difficulties that the pandemic has brought on the business. You're looking at things not just from your own side alone, but also looking at things from the side of the customer. And in that way, the customer sees you as a partner who is ready to, work with them even in this trying period. One key area that we need to also consider is in terms of cash. In these times, many businesses are looking to cut down on spending, and what that means is that cash will be king at this point in time. How do you ensure that your receivables is brought down to the barest minimum? You may need to look at strategies that you can put in place, such as either giving discounts, either considering shelving credit sales as a whole, asking for advance payment in some cases, so that you can minimize your receivables as a whole. Another thing you may want to look at is agreeing payment terms or having a payment plan in place for especially your big customers or customers who you know that the pandemic has impacted them severely. You may want to ahead of them coming to you to you may want to be proactive in that regard by telling them or offering them payment plans that will be convenient, or that will make it easier for them to be able to meet their obligation. Having said that, another key area we need to look at is the area of supply chain management. As you know, every business you always need to worry about your supply chain, either with your suppliers or even with respect to logistics. So that's a key area you need to look at because, as you know, the pandemic is hitting every business in one way or the other, and some of your suppliers may be impacted. And if you do not quickly take a good look at that, it may cut down on your production, may impact your production, and you may not be able to meet your client's needs. So that's an area you may need to look at in terms of assessing the impact of the COVID-19 on your supply chain, and taking detailed steps to respond to how that has impacted you. One of the areas you may need to look at is to look for alternative sources. As we know, China, where most of the resources, natural resources come from, was impacted before most other parts of the world, and many of their factories and many of their factories were shut down, and that has impacted production in many countries. Now you may need to look at alternative sources for your raw materials or for your resources, such that you can continue to meet your clients' needs. I must say one thing at this point, that during this pandemic, this is not a time to lose customers. So even if you have to get more expensive sources to continue to meet your clients' needs, you want to make sure that at this point in time you retain your customers. Another area is we also know that logistics has been impacted severely due to the pandemic. Cargo planes have been limited in terms of their operations, and so you may want to consider bulk buying or bulk purchasing, so that you can take advantage of the limited availability of this transportation system. They want to consider bulk purchasing from your suppliers. Another thing is to look at areas where you can have escalation mechanisms in place to ensure that crises, when they happen, can be quickly addressed, or they can quickly be dealt with. And that is quite important because, like I mentioned earlier, you want to ensure that your customers are retained in this period by all means. The next point I would like to touch on very quickly is budgeting and forecasting. As you know, many organizations, budgeting and forecasting is a strong control tool for organizational management, but many organizations tend to carry out this activity as a routine rather than something that as a control or something that is a cost management activity. In these times, this is the time to really sharpen your skills around forecasting. You may want to look at review your budget. Even the federal government of Nigeria has reviewed its budget. Public entities are reviewing their budget. And of course, that has a ripple effect. But as you know, our economy is somehow driven by what happens in government. So you may want to look at your budget, review your forecast, identify budget lines which before the pandemic were things you were looking at they were not really going to impact your capability as a business. They were not going to impact your unique selling point as an organization. You may want to begin to look at those kind of budget lines and begin to cut down on them. Another thing you may want to do is to look at consider using the 80-20 rule. As you know, that majority, 20% of your efforts basically gives 80% of the results. And so the other 80%, you may want to take a critical look at them and see which ones you can do without at this point. Labor redundancy is something that, of course, the COVID-19 has brought on us. Many organizations are finding that their staff, majority of their staff cannot be put to good use because the impact of the health impact of the corona has either hit their staff or is making their staff to not to perform at their full capacity. So you may want to look at your workforce and find ways of either redeploying those who are not very active or who are actually carrying out activities that are not value adding or directly adding to the bottom line, and look for ways of engaging them in other areas. I must say that what has been observed is that organizations have just most of the organizations are actually just looking to just cut the number of staff numbers, whereas without carrying out a detailed assessment of the activities and value creation activities within the organization where they can actually redeploy some of their staff. Capital projects or expansion projects that you may have commenced or you may be working on. This may be times to also look at those budgets and then perhaps hold on such projects. The final point I would like to talk about has to do with spending. I think at this point in time, it's critical that you carry out you probably look at a zero-based form of budgeting or forecasting, whereby all your costs, you either put them in a parking lot and begin to take them out of there, one by one after a critical assessment of how they contribute to your strategic objectives or to you achieving your goal, or how they differentiate you as a business. So you want to classify your businesses, your costs into those you can do without, those you want to the cost that you don't have to spend now, those you can defer, and those you can even get rid of completely. You want to classify that, and of course you want to look at your operations and see whether you can find areas for efficiency in there. Are there things you can do better? Are there things you can do with them less without spending so much on do them? Or are there things that you can do differently? Of course, many of the things I've talked about, I know that it may be difficult for you as a business to carry them out entirely on your own and you may require the services of a third party, perhaps a consultant, to assist you in driving some of these things. PwC, we are always available, and we can support you in some of the areas that is being shown on the screen. I think at this point I would like to stop and allow Taiwo to take things from there. Thank you.
All right. So thank you very much, Gbenga. So that was comprehensive. And we know also from our various studies and surveys, both within Nigeria, regionally and globally, that cost cutting is one of the major areas of focus for many businesses. So we'll come back to you with a question later on. So now I'm going to just ask Bolanle, a question. The publication, produced by PwC on the accounting and reporting implication of COVID-19 covers quite a number of areas, but two of that particularly are of interest, and that's to do with government palliatives. We know that everybody is asking for stimulus or palliative or incentives here and there. And then there's the point around going concern. So businesses that would otherwise be viable are being threatened because of COVID-19. So the question to you is this: would it, under any circumstance, be appropriate for a business to say, well, I think I have going concern problems, but I'm also at an advanced stage of, assessing government palliative. Can I then assume that my going concern is not under threat?
Thank you, Taiwo, for that question. Very good question. And the answer is no, because going concern, you have to look at it from from the point of view of you can control. And it's not certain with regards to the palliative, whether it's going to come through or what time it's going to come, how long it's going to be for. There's a lot of things around it which are outside your control. So a lot of your going concern has to do, looking at it for the next 12 months, has to be around what you what can control. In addition to that, IAS 20, which is a standard that covers going concern, talks about two ways that you can sort of apply it. You can either apply it using the capital method, meaning that you either use it to sort of as a like a deferred type of income or a deferred type of as a contribution in your equity. While the second one is either for your POL, either you use it as other income that's coming in, or use it to reduce a particular cost of sale on your revenue line. So because of that, those are the only things that are available to you. So you cannot use it as a form for going concern.
All right. So thank you very much. So until the money is in the bank, we cannot anticipate it. All right.
You need to have it.
Fair enough. All right. Thank you very much for that, Bolanle. Let me ask the next question to a Siri around managing your wealth, re-examining offshore assets and all of that, which I think is all very good, and people should pay attention to that by all means. But then there's this perception generally about trust, whether you're talking about the Panama leaks or Paradise Paper, and there's this negative connotation everywhere about trust. How do you then balance the fact that you need to take advantage of protecting, planning, optimizing your wealth using trust with the public perception?
Yeah, thanks, Taiwo. I think truly it's a balancing act. While tax havens are seen very negatively, as we saw with the Paradise leaks and all, there's still some economic advantage to having those. One of the considerations for havens like that is really around the economic value they bring in globalization and advancing investments to other jurisdictions, but also with the stability that all those havens prefer, so that to the extent you then have economic instability in other jurisdictions or political instability, they do offer some protection. But truly, it has really been abused in the sense that a lot of the tax havens also have tax-free status, so that the incidence or the tendency to then move or shift profits there and not pay taxes really does exist. And then using offshore trust as well then becomes, or is seen then as a tool for just tax evasion. But I think the most important thing to consider if you're a wealthy person looking at using those trusts is, one, you do need to look at the jurisdiction that you pick before you take out action to set up a trust there. There's a lot of blacklisting, either by the EU, and sometimes the OECD is also advancing that on jurisdictions that are not fully transparent about what goes on in their jurisdictions. And so we're having now a lot more exchange of information between countries so that it heightens or increases their transparency indices. That is a very good factor to consider. Another thing is also, where is the source of that wealth coming from? You know, how have you settled taxes in the jurisdictions that you're coming from? And what is the commercial rationale as well for setting up the trust? To the extent that, you know, the timing between when you set up a trust and when you're probably getting proceeds from the disposal of an asset that you own and shifting those proceeds there, if that timing is really short and then just looks like something that has been done for the purpose of just escaping or evading taxes, then it almost then looks like a sham. And so it's really about advanced planning, thinking through what is the commercial rationale. And there really are substantive reasons for setting up trust apart from tax evasion. Like I said before, it's really about continuity of estate. It's about things like avoiding administration of those assets when you pass on, because it then becomes so difficult and tedious in jurisdictions that don't have full legislation that protects you. So asset protection, estate planning, continuity of those estates continue to be very valid reasons for having those setups there. And then tax then becomes a secondary reason where you've considered all of those properly. And then also how you administer the trust itself. There might be a lot of consideration now put to philanthropy, because some of the reasoning that's coming up from the NGOs who are putting out all these papers is more an ethical thing apart from legal. So the structures might be legal, but there is no morality around just stacking money there and not advancing causes for other less wealthy people. So if you're a philanthropic person, perhaps that's another opportunity to begin to use those assets to better use in those jurisdictions and being a lot more transparent about it. You know, and I think with time, it's only a matter of catching up, because we have a lot more countries now signing up to exchange of information agreements. So there will be a lot of pressure on all of these tax havens. And adequate reporting is very important. Administering the trust properly is very important. Having all your documents tied up, T's crossed and I's dotted, very important, so that if there is any leak of any sort later, you know, you have a better protection for yourself and for your family.
Thank you very much, Esiri. So plan ahead, make sure you do the right things, focus on what you can control. You maybe cannot control the narratives and the perception by the public, but do make sure that what you're using your trust for, or why you're in a particular location offshore, is for the right reasons. So thank you for that. So my next question will go to Benga. In the publication by PwC on cost management and value optimization strategy, so I found something interesting, and that was to do with bad cost, good cost, right? So, and the question is, how often should we be looking for these costs? Who should be doing the looking? And when you do find them, what do you do with them, whether they are bad or whether they're good?
Thank you very much, Taiwo. Interesting. I think the first thing is to define what are good costs and what are bad costs. The interesting, and also I think the next question is to answer who should be looking at them, who should be watching out for this. Good costs basically are those costs that of course help you to achieve your strategic objectives. Okay, costs that you incur, and of course they let you inch towards achieving your goals or objectives or strategy as an organization. On the other hand, bad costs are those costs that relate to wastages, of course, which maybe as a result of inefficiency, costs that you are incurring that are not adding to the bottom line as a whole. And of course, the interesting part is that in an organization, even the employees, right, all the way to management, they know this cost. Interestingly, they know them, and they are aware of them. But then, who should actually take responsibility for this cost? The response is that at all levels, both at the tactical level, at the management level, and even at the whether board or strategic level, everyone should be concerned about them, and everyone should take responsibility for this cost. But what should you do when you find them? It's very simple. Good costs, incur them when you find them. Okay, if we do this, then it will lead to efficiencies. If we incur this cost, what will happen to us? We will definitely be saving money. Then I think the response is go ahead and incur that cost. On the other hand, when you find wastages or inefficiencies or things that you think they're nice to have, and in a situation where we are looking for savings, or where we are in a pandemic and we are trying to make the best of a difficult situation, those nice to haves can be deferred for a later date. They may not necessarily be bad costs, but in the circumstance or in the situation we are, they may want to qualify as bad costs. So in direct response to your question, I think at every level of an organization, right from the tactical level to the senior management level, they should take responsibility for costs. And when bad costs are found, they should definitely be taken out of context in terms of spending. Thank you very much.
All right, thank you very much, Benga. So I like the fact that even when you identify a good cost, you should still be thinking about, can I make it even better? Can I defer the payments? Can I reprioritize? Can I get more value from it? And that's very useful. One thing that normally comes to mind for me each time we're talking about cost cutting is that it's important for business leaders to take a medium to long-term view when they're making those decisions, because the temptation, for example, is to try and cut anything and everything. We've seen organizations where they just give a blanket rule, reduce all costs by 25%. So that's never the right way to go. We've also seen companies that will just cut things like training. That's because they can't see the impact immediately, but what they're doing is then compromising their ability to adapt to changes in the market and compete in the long run. This is really the time you need to upskill, for example. So there's no one size fits all. There's no one right answer for everyone. Every organization has to look at their own circumstances and make the best decision for the organization in the short, medium, and long term. I do not see any other questions. So therefore, I think I'll just ask the panelists to give their closing remarks in 1 minute. Just try and keep it to 1 minute, each of you, and then we can close the session. So let's start with Bolanle.
Thank you. Thank you, Taiwo. Just a few things to say. The first one is, if you have yet to do a detailed financial reporting impact assessment on COVID-19 for your business, please do that. It's not too late. You've got your year end coming up. It's good to start preparing for the likely impact so that you can start working on easing them, so that whether you need to amend timing of certain contracts, need to make some decisions around certain judgments and estimates that you need to do, please do that. Which leads me to the next thing with regards to, please reassess any of your cash flows or budgets or estimates that you have done that you used to make certain business decisions, because where things were in March, or maybe when you did them last year or looking for this year, you need to do them and make sure that you're doing them monthly, because things are quite fluid at the moment. The first thing I want to say is around assets. You might have a number of assets that you might be sitting, maybe certain warehouses, certain offices, floor spaces that you may not be using. This is the time to try and sweat those assets. Find other ways that you may not necessarily use it for your business, but you can, look at, looking at subleasing it, looking at making use of some of your subsidiaries, or even getting rid of them. There might be other people that are using them. Of course, bear in mind tax implications, but please, this is not the time to leave assets just lying around and not making use of them. Sweat them. And then the last thing I want to say is with regards to funding funding and looking at other ways of funding, cheaper ways of funding. There are a lot of opportunities out there to help looking at your cost of capital in your books, around some of your receivables. Look at ways of finding alternatives of funding, whether it's going to the capital markets to go and raise a bond. People are looking for other alternatives, where to put their money at the moment because there's uncertainty. So if you have a good business and you know that you're doing well, you can go out there and try and raise money and look at capital markets. So yes, and of course, have a look at the other areas around the actual reporting, which I talked about. Thank you.
All right. Thank you very much, Bolanle. Siri?
Thank you, Tayo. I think the very key point I want to leave here is, the topic is really around re-examining offshore assets. But over and above all of this, it's really around preserving assets and protecting them. One, for the current generation. Two, for the future generation. How do I ensure that it passes on to the next generation? And so how do I ensure that that value does not decline over time? And in declining over time, some of the themes or key considerations really is around also not only foreign exchange, but also taxes. Taxes can be a big bill that just reduces the value of your asset because you're paying something over to the government. Now, we've talked about a number of options. We've looked at the trust arrangement itself, offshore, and some of the risks that can come through. While, emergencies like we had presented might be rare in some of the offshore jurisdictions, but they might happen. No one expected COVID. It came. And then now we're beginning to ask questions around whether we have right structures in place. But another thing as well to consider is if it then does happen, what structures do I have now to prevent it from happening again? And then two, is there anything I can do differently with the structures I have offshore? Is there anything I need to do as well with the structures I have locally? A lot of attention is not also paid to how local assets are held, unfortunately. And I think that's a combination of factors ranging from whether lapses on the tax authorities or government authorities in not implementing laws. But then again, it's an area that needs to be considered as well for completeness in all of your assets, whether it's on preservation or protection. And so I would just encourage that we also do re-examine structures that we have locally and offshore and look at ways to tighten or close any gaps that could potentially reduce the value of the assets or wealth that you have as an individual or for your family or for generations to come. Thank you.
Thank you, Siri. So the point is re-examine everything, not just offshore assets. Benga, your closing comment.
Thank you, Taiwo. I think I'll start from where Taiwo stopped the last time. In looking at costs, you need to look at sustainability. Sustainability has to be at the back of your mind. It's not just a cost-cutting measure for the time being, but beyond that, you need to be looking at actually having a cost management system in place that ensures that from time to time you begin to consider improvement in your business, and of course tying your strategy or your objective to every cost that is being spent. That in a way ties to your enterprise performance management, whereby every of your strategy is linked directly to the cost that you incur. So on the final note, I would just say to you, look at things in a holistic way rather than just cutting staff or cutting spending. Look at things holistically in taking a cost management approach. Thank you.
Thank you very much, Benga. Yeah, so it's always good to look at things holistically, so you don't solve one problem and then create two other problems. So we are going to wrap up now. So thank you very much to our panelists. Thank you also to the Capital Club. And thank you to the rest of our team at PwC. Just so you are aware, at PwC, we have been supporting various stakeholders from government to private sector, state-level governments and organizations in terms of their responses to COVID-19. We have a dedicated portal. Within our website, there is a microsite, and within that, you find a lot of resources around COVID-19. We invite you to kindly visit from time to time. The information there is updated. I won't say real time, but as quickly as possible when we have new developments. So this will really help you, one, to be able to adapt quickly, and also to give you the competitive advantage to thrive despite COVID-19. On this note, we'd like to thank you all again, and then please do stay safe. Bye for now.